Howdy, Jacob here. Today we're looking at Etsy in the broadline retail industry. They operate two-sided online marketplace that connects buyers and sellers globally, and it was founded in 2005, headquartered in Brooklyn, New York. So it's a lot newer of a company than some of the other ones we look at, but still enough to see a long history. In this history, we see immense growth from 2014 all the way till just after COVID, but we do see massive declines in revenue growth. Again, still growing, but just nowhere near as much as what they used to be from the last 2 years, going from 35%, which is pretty consistent from 2014 to 2021, to 10% in 2022 and 7% in 2023. The gross margin is down from their COVID highs, but is above their pre-COVID levels. So not too concerned about that. Same with the operating margin. Double-digit operating margin always makes me feel a lot more comfortable. And what am I trying to say? No dividend. And so there's return on invested capital. If they can find ways to reinvest at those rates, hopefully they do, because they don't have the capital tangled up with having to pay out a dividend. R&D is going to be a good chunk of this. I mean, we're looking at over 15, maybe close to between 15 and 20% of expenses is going to be their research and development. So they are taking a lot of their money from today to hopefully make more in the future by researching different ways and developing different ways to make that money, to be more efficient with the current web sources they have, current ways of selling that they have, and finding other opportunities to make more and be more efficient. So that's great to see. And it has been growing immensely. They have 914 million cash, 236 short-term investments. They have 2.3 billion long-term debt. So maybe a billion and a half net of debt. But they produce over half a billion a year, at least the last couple of years in free cash flow. So we're definitely not concerned with that debt figure. It's less than 2 years. Absolutely not concerning. Majority of their money is going to share repurchases and a little bit going to reinvestments, debt reduction. So if I look at this capital allocation, if I were to see reinvestment and acquisition be the highest rate of their capital allocation, and with this massive return on invested capital, I think it would deserve an excess premium. But given the fact they're repurchasing shares, again, it's not saying repurchasing shares is not the best thing for them to do with their money, but that's telling me that they're not reinvesting in the business to get those types of rates of return. And so that's also going to artificially inflate your return on invested capital because your denominator gets dampened, which again increases your net operating profit over your equity figure. So right now, I think there's a lot of growth. I mean, obviously we see it's dampened a lot, but I still think that Etsy does have a good amount of growth ahead of them. I think a lot of people understand the company and like the product, that the products that they sell, that they're, in the exchange of selling. I don't know if they actually sell anything, but I think that still gives me hope for their revenue growth in the future. And for me right now, given a little bit of capital allocation to possibly investments and acquisitions, I think 7% seems pretty reasonable to me. With the possibility of that high rate of return and growth rate, I think still being there at the end of 7 years, I think 18 probably good. Maybe seems a little high in my eyes because I try to be more conservative on that front, but I think that that's something that I'd be comfortable with. And then the fact that their free cash flow is so much higher, I absolutely do love that. So maybe let's try about 20% and 22% with shared change. 1% is going to be about 60 million. If they used about 75% of free cash flow of 700, I mean, you're looking at 70 times 70, 490, roughly 500 million, offsetted by stock-based compensation, a little over 200 million. I mean, that's going to be 3-4%. Let's say 3.5%. And wow, really wasn't expecting that. So with these current assumptions, we're saying that is a buy right now. So that is very interesting. I mean, I trust free cash flow margin more than net income margin, and so I do like that the free cash flow margin is higher. I don't necessarily like that it's lower than what it was the earlier parts of the late 2010s and early 2020s, but um, there's a lot of competition now. But again, I think if they're able to hold it, they're able to hold that competition and hold these margins and repurchase these shares. This could be a very advantageous time. So this might be something I got to do a deeper dive on. Hope you enjoy the video of yesterday.